Every chart tells a story, but most traders never learn how to read it. They chase indicators, signals, and hype, forgetting the market has its own language. A language written in highs and lows, in trends and reversals, in the very structure of price itself. If you can read market structure, you can see where the money flows, where smart money enters, and where the majority gets trapped. This is the foundation behind every strategy, from scalping all the way to swing trading. And today, I'm going to break it all down, step by step. No Elliott wave, no complicated indicators, just pure price action. By the end of this video, you'll know exactly how to spot the story hidden behind every single chart. Welcome back to the channel. My name is Ramteen, or Ram for short, and in today's video we're diving deep into market structure and how to read it the right way. I'll show you how to identify trends, spot swing lows and swing highs, and how to create a bias for your investing or your trading purpose. After learning this, you will have the confidence to attack any single market you desire, whether that be crypto, stocks, or even commodities. Anyway guys, I hope you enjoy the video. So before we dive into the technicals, let's understand what market structure really is. So market structure is simply how price moves. If we're to look at any chart, we all understand that nothing goes up in a straight line or down in a straight line. If you're to look at any chart, you will see patterns that exist across all time frames, and these are delivered as structure that can be broken down with highs and lows. And once we can understand where we are in a trend or in an overall market, that is where we can get the best entries for our trading, for our investing, and overall enhance our edge against the markets. So like mentioned earlier, price movement is reflected in patterns delivered in the form of structure. It is also crucial to understand, just kind of like I said, it's going to give you a framework for your entries and where the market is headed. So after understanding what market structure is, so let's get a little more technical and dive deeper here. So obviously we want to understand how to identify highs and lows. A high is simply where price peaks before pulling back, and a low is where price bottoms before moving up. Pretty simple. So if you look to the right here, I went ahead and annotated two models. Let's go ahead and zoom out here. So this model here is an example of a bullish trend where price is making higher highs and higher lows and is continuing to do so. So we understand that this price action is in a bullish trend. And if we look to the right here, we have a bearish model followed with lower lows, lower highs, lower lows, and lower highs. We can see price had a move up followed by a pullback here. After this pullback and price expands, this higher low is then formed, continuing on to make a higher high and a pullback creating a higher low. And what's also important to understand, in real time, you don't understand that this is a higher low until this higher high is ran. And same thing across the bearish trend, just inverse. And the beauty of market structure, guys, is that it's fractal across all time frames. So if we're to look at this low here on a smaller time frame, we will see structure that can give us clues that the bottom is in and price wants to continue to the upside. If you guys can't already tell, market structure is one of my favorite ways to look at the market, and honestly it might be the only thing you need. Of course, there's other concepts to tie in as well to increase the probability of success in your investing and or trading. But if I were to go back and learn all over again, I would 100% choose to master structure. So now that we have a simple understanding of highs and lows, we want to understand that underneath each high and low rests liquidity, aka money. So if we're to refer at this model again, so if we observe our model here again, let's go ahead and spot the liquidity in the market. So again, above every high and every low rests liquidity in the market. So we understand that above this high, there are orders in the market that either need to be filled or in the form of stop loss where retailers are liquidated and then turn into buyers to push price to the upside. So underneath this low, we understand there's liquidity. Underneath this high, we understand there's liquidity. And underneath this low, we understand there's liquidity, right? So you might ask, if there's liquidity underneath these lows, why didn't the market want to grab the liquidity and maybe reverse to the upside? Well, that's a great question. So these lows act as swing lows in the markets where either the composite man or institutions are protecting their orders so they can stay in profit. So if we're to observe this low here, we understand that there was a protected low here and another protected low here. And yes, it still does hold true. There is still liquidity underneath these points, but simply the liquidity at that low did not follow the market's agenda, hence why it is still standing. Now, can the market come back and grab these lows later? Absolutely, we see it all the time. But once we see these protected lows followed by expansions, we understand that there's some footprints in the market and we can use market structure to get involved. So now that we have a basic understanding of highs and lows and liquidity in the market, let's understand a break of structure versus a liquidity grab. And most traders struggle when it comes to understanding the difference between a break of structure and liquidity grab. But once you understand your overall higher time frame bias, it becomes much easier to distinguish between the two. So technically, a break of structure is when price takes out a high or a low and continues in that direction. It usually indicates a trend is continuing or ready to reverse. And liquidity grabs is when price breaks a high or low in a current trend and continues in the opposite direction. So if we're to, again, observe a model here, we can see both liquidity grabs and break of structure. So if you guys recall, we have a higher high here, followed by a higher low and another higher high. So at this point here, the market broke structure to the upside. It broke this high and continued the trend, and followed by a retracement. Now at this low here, there was really two things price could have done. It could have either gone on to take the high out, which it did, or come down and take out this low, which would be considered a break of structure. But as we can see in this model here, price pushed up, took out this high, creating another higher high, followed by a move to the downside, taking out this low here. And as we went over earlier, we understand that this low here clearly had liquidity that the market wanted to grab, or maybe even needed to grab before continue going to the upside. And yes, in the moment, this here is a lower low. Price continued to push to the upside, taking out this high, creating a higher high, followed by a higher low and another higher high. So we're continuing to break structure to the upside. And then what we see here on this last higher high, we had a move to the downside, taking out this low, creating a lower low here. And right here at this point, this is a very pivotal point. Either traders are assuming it's a liquidity grab, or they have the notion that this is a true break of structure and their market is getting ready to reverse. But for this example here, this was a real break of structure because we had a lower high following and continued with a lower low. So we understand the intention of this move here was to break structure and push price lower. In future videos, I'll be sharing how to distinguish the difference between a liquidity grab and break of structure so you don't get caught in these moves here. And of course, when price breaks structure, most traders are assuming there's going to be a complete collapse of the trend, which on this specific model, they're technically not wrong. But what most traders and investors fail to do is zoom out and understand the higher time frame bias. Just stay with me, guys. This is where things get a little complicated, but don't worry, I'm here to break it down. So obviously we can see prices breaking structure here, like mentioned. But what we can understand is that this move here could be a part of a higher time frame push to the upside, followed by a retracement. And of course, if the higher time frame wants to push higher, we'll see the chart manifest as such, pushing price to the upside. I'm not going to go too in depth in this video because it can get a little tricky, but once you understand how to identify fractal structure across all time frames, that is when you have truly mastered structure. So if we go back to this here, we can see this higher time frame push here, and at this higher low here, we will indefinitely see some sort of break of structure to push price back up to the upside. Once you have mastered the ability to look at market structure, that is when you actually have the ability to indicate when bottoms might be in. So what I'm going to share with you guys is the strategy I used to catch bottoms back in 2023. So if we go over to the others chart, which is the market cap of all cryptos, excluding the top 10. Let's get rid of that there. We can understand there's clearly a very prominent structure at play. So if we observe, we have a high followed by a higher low, higher high, and a potential higher low here. And the reason that this is not a higher low yet is because we have not taken out this high. But at this point, it's fair to assume that this will most likely continue to the upside, and this would have been the higher low. So the strategy I used was simply observing the market structure and positioning myself. Let's break this down. So for the look back, we understand the structure was as such, and that we were currently in this range here from this low to this high. Right? So I isolated the range from the low to the high. That is where I am within structure. Once you understand where you are within structure, that is when you can understand where you want to get involved in the markets. So for example, here on the chart, of course, I chose not to get involved at these highs up here because I understood the market was already overextended and we were most likely getting ready for a pullback. And as we can see here, we even shifted on a fractal level, which indicated to me that it was not time to buy yet. Of course, if you guys don't already know, I was working a regular job back then. I was simply maximizing my income so I could position myself to the best of my ability. And the key for me was to maximize my income, which I already kind of shared with you guys, and buy at the necessary levels. So once price started ranging here, I understood there was only two things price could do if we wanted to maintain the bullish sentiment. Either price was going to continue to range and then continue upwards, or price was going to come down here a little deeper into the range and then continue higher if the higher time frame trend wanted to continue. So there were really two options for me. I buy here and I catch the move to the upside, which is what happened, or I buy here and my bags come down a little bit, but guess what? I buy more because I understand that structure is at play and all that is happening here is price is coming deeper, maybe to fill some more internal liquidity to then push higher. So I wasn't worried because I packed my bags here. And of course, as we know, the market has appreciated quite a bit since then. And to be honest, guys, I truly believe this is just the beginning. And of course, we might stall out for a little bit. Things might get boring. But again, if we observe the chart here, we understand that structurally we can anticipate price to move as such. Anyway, guys, I hope you enjoyed this breakdown. I will be dropping more videos soon on market structure, so definitely stay tuned. If you guys have any questions, please leave them down below. I am more than happy to help. And my homework for you this video is, like mentioned earlier, grab a notepad, start practicing structure, and then after that, that's when you can head to TradingView, practice labeling structure, identify the liquidity grabs, the breaks of structure. And if you keep doing that over and over again, it'll literally become clockwork. You'll open a chart and you'll understand structure behind the market you are looking at. If I were you, after watching this video, I would just get right to it. So I wish the best of luck to you guys. Thank you.